why boutique hotels? And are you guys looking for cash flow or like a big exit when you sell?
Yeah. So basically, the model that I follow with boutique hotels, I'll just give you a couple like buying criteria that I have that fits the model that I look for. I don't go buy turnkey properties because that's basically people buying for cash flow. I don't buy for cash flow. I buy for value add, forced appreciation, and big refinance or big exit. And so I am looking in states and areas where there is already a demand or an increasing and high demand, coastal, mountain, lake, river, national park, something that is driving people there, right? So Solvang is a feeder city from Santa Barbara and LA, where it's a wine country destination. There's weddings, there's events, there's festivals, there's already demand in Solvang. San Diego, other California cities. So basically, high demand locations, and then existing Airbnb regulations. So the tighter the Airbnb regulations, or if Airbnbs are banned, the better it is for hotels. And so you want to be in a city where there are Airbnb regulations. So I wouldn't necessarily buy a boutique hotel in Scottsdale because there's no regulations in Scottsdale on Airbnbs, and it's like an Airbnb mecca for bachelorette parties and all this stuff. So boutique hotel might not do as well in Scottsdale. And then in terms of the model, basically my velocity of money strategy is how I approach hotels. And so using leverage, right? This is true of any asset, any real estate that you're buying, you want to use leverage. And one of the benefits with boutique hotels right now is I'm looking in the $2 to $12 million price range. And the reason I'm doing that is because it's too big for individual investors, like a mom and pop or a single person trying to buy a hotel, but it's too small for institutional investors. So they are not paying attention. And so there's a wedge market, and it's a bunch of baby boomers that bought their properties a long time ago. They're in distress, but they're still in relatively decent condition. They need to be updated indoors, maybe the outdoors. They haven't made any technology updates. Maybe they're not on all the OTAs. But in terms of leverage, like getting financing on the property, a really good option now is with seller financing, because these owners, they don't necessarily need to take all the money. They don't have any debt on the property because they've owned it for so long, or they have very little. And so they'll take a smaller down payment. So you can put 5 or 10% down with the seller, and then they take that, and then we pay them a monthly or quarterly check. So they basically get a full retirement check from selling their property to us. And then we save because we put less down on the property initially. And so having that type of leverage where you're not having to always put down 20, 30, 40% really helps your return profile. So that's a big benefit. And that doesn't happen all the time, but that can happen a lot of the time with where we're trying to buy. And then another part of the velocity of money and part of our model is forcing appreciation. So with boutique hotels, you come in, yes, it's renovations, yes, it's design, amenities, it's all of that. But part of it is actually just running the hotel better, increasing your reviews. Maybe you convert a manager's unit to 1 or 2 more rooms. So they used to have managers that lived on site. If you don't need that anymore, you can convert that to a room. And now all that money on that new room is profit, which increases the value of the property. You can do some sort of self check-in or staff light. You can add pets, being able to handle pets at the property. So you're looking at ways to operate the hotel better, increase the marketing, get on all of the OTAs. And that alone can increase your NOI, can increase the profit of the hotel, which increases the value. And then you add on all your improvements, all your amenities, all your renovations, and you try to stabilize that for at least 12 months. And then at that point, you either do the refinance and your big hit, or you can even sell at that point. And so it depends on what you've committed to with your investor team, what price you're going to get, who the buyer is, what you can get for a refinance, what rates are. So at the 3-year mark is when we start to look at what we're going to do. Are we going to refinance or are we going to exit? But in the beginning, when we pitch this to our investors, we typically do either 5, 7, or 10-year holds. But we let them know that if we can exit at a certain price, we will. Because again, with my velocity of money strategy, we need to look at our equity multiple. So if you don't know what this is, basically, if an investor gives money, if they give $100,000 and we can pay them back $250,000, that's a 2.5 multiple. And so that's what we try to target. We try to beat that, but that's what we try to target. And so let's say at year 4, we get an offer price to sell that gives you a 2. So we would return $200,000 on your $100,000. But it would take, if we didn't sell and we held it and we waited until 7 years or 8 years or 9 years, to get to that 2.5. Think about that. In 4 years, we got to 2, but in 7, 8, 9, 10 years, we got to 2.5. So we're waiting an extra 3, 4, 5, 6 years just to get an extra half of a multiple. So that, to me, that's when I talk about velocity money, that's part of it, is like, okay, well, yeah, we're not giving you your 2.5, but we got you 2x
That makes way
in.
more sense to do it at the 2 and not wait another double amount of time for not the double amount that you already get.
Exactly, because then we can take that and we can do it again. And so if you can double your money every 3 to 4 years, that's what this strategy really is meant to do, is double your money every 2 to 3 years. Just on the cash flow and exit, that doesn't even count the tax benefits, right? So just on your cash flow distribution and your exit, if we can double your money every 3 years, that's where I like to be. That's where I like to be.
And then, I mean, you've only been in this game. Obviously, you've been in real estate for 4, 5, 6 years prior. But in the hotel space, how many projects have you done or are currently working on right now?
So we have closed on Solvang April 2nd, and I'm under contract on 2 others. One is up in Washington, and there's another one down in California. And each one is a little bit bigger and a little bit different than the last. And so the strategy on the one up here in Washington, same thing, renovate. But what I started finding when I was doing the underwriting on this stuff is I was able to take kind of all my old knowledge from short-term rentals and other real estate transactions, and my engineering background and my number, my ability to look at numbers. And so I started figuring out, yeah, my nerdy background, we can call it that. That's fine. I started figuring out, like, okay, here's how the numbers really work. Here are the levers that are really important on a per project basis. Like looking at a project and being like, okay, here's where we pull the levers to maximize the output. And that velocity of money, that 2.5x, 3x, or doing it sooner, that's where that's starting to come from. And looking at the IRR and the ROE. But this is what I like to do. I like to continue to grow and scale as I can. The 2 projects that I'm under contract on, those I'm going to be more heavily involved in on design, renovations, managing, than I am necessarily on the Solvang deal.